Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. Guys, try to remember that technical analysis, fundamental analysis, it's all great. The more you know, the better. But one thing I've learned reading through the financial headlines, it's an art form in the form of a puzzle. If you want to know what the prime banks and brokers want you to believe, you have to read the tea leaves. These people are rarely speaking about what will be good for the retail investor, but rather what they want to happen and what they want you to believe. So what are they saying right now? From Markets Insider, the stock market's buy signal is dead and the monster rally surges closer to overbought levels, Bank of America warns. And then from Yahoo Finance, JP Morgan brings out bear case for stocks in 2024. JP believes the calls for a consumer slowdown will come to fruition in 2024. Now, I agree with that in part, but here's the important part. And halt the current stock market rally. You see how they snuck that in there? And then Market Watch. U.S. stocks to fall around 8% next year, says JP Morgan. And from Bloomberg, B of A strategist who predicted the 60-40 rally in 2023 warns of drop. Now, I'm not saying they're wrong. This could all happen. What I'm hearing, though, is they desperately want a correction that hasn't happened yet. And yes, both Bank of America and JP Morgan are or were shorters of AMC, and so are their hedge fund clients. JP Morgan owns 100% of Highbridge Capital, and they have appeared on our list of shorters. Highbridge was also one of the creditors listed in the prospectus when Adam invested our money in a formerly bankrupt gold mine, while at the exact same time was embroiled in a blackmail/sexting scandal. And yes, all 5 of the lien holders at HYMC at the time either were or are short sellers of AMC. So run along now and pretend that's not a breach of fiduciary duty. I'm sure Adam had our best interests in mind when, without any precious metals experience whatsoever, invested our money to help a group of our short sellers while sending pictures of his junk on his cell phone. If you don't believe me or don't like hearing the truth, then go read the prospectus for yourself or go bury your head in the sand. I could care less either way. But don't call me a shill when I point out uncomfortable facts about a CEO that's been screwing over the shareholders since this whole thing began. As for poor Hycroft, a company I like, by the way, it's down almost 98% over the past 5 years, so I could tell Adam Aaron is involved. And this is with the spot price of gold over 2,000 at the time of this recording. According to Macro Access, not Uncle Frank, based on the latest financial disclosures, Hycroft Mining has a probability of bankruptcy at 82%. This is 84.93% higher than that of the metals and mining sector and 74.88% higher than that of the materials industry. The probability of bankruptcy for all United States stocks is 105.87% lower than Hycroft Mining. So, guys, this should give you some indication at how good Adam is at picking stocks, or was there some other reason he did this? And on topic, did you know Adam quickly resigned from a board seat that he's occupied for years? From back in October, Adam Aaron, a longtime director at Norwegian Cruise Lines, resigned from the board effective immediately. I wonder what was going on at that time. The resignation did not involve a disagreement with the company on any matter relating to its operations, policies, or practices according to the filing. Well, I think we know what it was about now, and I think we need a Ryan Cohen of our own. Wouldn't you agree? Okay, let's do some swan watching now. From MoneyWise, the buildings don't go away, but the owners do, Before his death, Charlie Munger warned of a storm brewing in the U.S. real estate market. From the article, one of the last market warnings Charlie Munger, Warren Buffett's late business partner, issued revolved around commercial real estate. Munger said he saw a storm brewing in the sector that could engulf the banks and impact the broader market. And maybe this is what Charlie was talking about. From Benzinga. Countdown to crisis. Evergrand in last-minute talks with major creditors to avert liquidation. From the article, crisis hit Chinese property giant Evergrand Group and its major foreign creditors are racing against the clock to strike a last-minute deal aiming to avoid the liquidation of the company's offshore businesses scheduled for Monday. The negotiations follow the collapse of a previous restructuring attempt vetoed by Chinese regulators. The proposed deal involves Evergrand offering its creditors approximately 20% ownership of its parent company. Compliance with Chinese regulatory demands includes the stipulation that Evergrand refrains from issuing new debt as part of the restructuring efforts, so they can't borrow anymore. Hey, Uncle Frank, your thumbnail said we're winning the battles and they're losing the war. Well, guys, before we get into all the AMC stuff, I want to take a minute to address what's going on over in Great Britain. Is London in trouble? Let's see. Let's start our analysis by looking at this article from Hedge Week, November 27th. Hedge funds bet big against Metro Bank. Short sellers are betting against Metro Bank ahead of a vote tomorrow by shareholders on a £925 million rescue plan, according to a report by Daily Mail. And according to the report, 6.4% of Metro shares are on loan to hedge funds led by Caius and Kite Lake Capital, making the bank the most shorted stock on the London market after online retailer ASOS. Hey man, the stock is way down. Over the past, I guess year to date, they're down 67%, less than AMC. Here's another article from BBC. Metro Bank. What's going on and is my money safe? Well, I think they did get bailed out. Reuters, Metro Bank investors back $1.15 billion rescue plan. This isn't good news by any stretch. Okay, I think they're at 50 cents now. Metro Bank's biggest shareholder is Spaldy Investments. It's an investment vehicle owned by Colombian billionaire investor Jaime Bacal, who built one of the biggest banking empires in Latin America. I think this bank had to sell more than half of itself, to bail itself out, and the stock hasn't recovered yet. But let's continue with our analysis of England. From CNN Business, only from this past Thursday, British banks announced sweeping job cuts weeks before Christmas. And there's Metro Bank in the picture. Staff at UK banks face layoffs in the lead up to Christmas in what one labor union called disgraceful timing. Struggling Metro Bank said Thursday that it expects to slash headcount by 20% as part of efforts to save $63 million US a year. The announcement, which will affect around 800 roles, came on the same day that Lloyd's confirmed plans to let go some of its employees and follows news earlier this week that Barkleys is shedding 900 jobs across its UK business. Let's talk more about Barkleys. Barkleys announces mass firing ahead of Christmas. Barclays Bank has announced mass firing targeting more than 900 jobs in its British business in order to cut costs intended to boost payouts for their shareholders. All right, let me translate that for you. They're cutting costs not to boost payouts for their shareholders. What that says is, please don't short us into the ground. Well, did you know Barclays appears on our list of short sellers according to Fintel.io? But there's more. And I'm sure none of you can forget this incident from Barron's on September 6th. AMC Entertainment is selling stock. The price is falling. Shares of AMC were tumbling after the company said it has entered an agreement to sell up to 40 million shares of Class A common stock through an at-the-market offering program. Also from the article, The agreement involves Citigroup, well, that's our main investment banker and a short seller of AMC, Barclays Capital, which is a short seller of AMC, and Goldman Sachs as sales agents, a short seller of AMC, and an epic spoofer of AMC, literally on a daily basis. Now, guys, let's see if we can't start tying it all together. Commercial real estate, bank closings, contagion, shorting AMC. Is HSB a short seller of AMC? No, they actually had a position in AMC, but they sold it all by November 13th. Here's a headline. HSBC to close 69 branches across the UK. HSBC is among the many banks to close bank branches, shutting 114 of its locations in 2023. The bank said the decline of in-branch banking has accelerated so much since the pandemic that some branches, which are set to close, serve fewer than 250 customers a week. But there's more. Financial contagion warning, as HSBC is told to brace for catastrophic £6.3 billion hit. Barry Lyndon fears losses in Hong Kong and China could blow a hole in the bank's equity. From the article, HSBC is facing a hit of more than £6.3 billion as a result of unsecured commercial property loans into China, a UK-based tax consultant has warned. Bob Lyndon branded the situation a disaster and warned of a financial contagion risk which could have a knock-on effect on Britain's economy. HSBC earlier this month confirmed it was setting aside £910 million to cover expected loan losses, including $412 million related to the commercial real estate sector in China. But Mr. Lyndon said the actual picture was much worse. The founder of Lyndon Consulting Services outlined his concern in an analysis specifically written for Express.com UK and has urged the bank not to underestimate the seriousness of the situation. He explained HSBC's stake in its Chinese bank, Hang Seng, looks overvalued by $3.3 billion given the benchmark set by Standard Chartered. 42% of HSBC's commercial property loans into China are either substandard or credit impaired. $4.6 billion out of $11 billion. That's a disaster. Quote, the equivalent figures just for Hong Kong are 63% and $3.8 billion out of $6 billion. That's a catastrophe. Even worse. Now check this out. $3 billion of this $3.8 billion was not backed by real estate security, Mr. Lyndon stressed. He explained that's an oxymoron. They should not be booked as real estate lending if they are unsecured. So guys, $3.8 billion, so $3 billion out of the $3.8 billion in loans isn't even secured by real estate. It's getting interesting. And what about outside of England? What's going on in Switzerland? Why is every AMC-themed YouTuber making a video about this equity swap? Let's read the tweet. Apparently it was filled March 3rd of 2021. What was going on in 2021, guys? Expires next month, December 15, 2023. The current price of the swap, $999 billion. Now they're claiming this is Archegos from Credit Suisse, then absorbed by UBS. No wonder they are restricting customer withdrawals. Well, guys, that's not completely crazy. Read the Daily Hodl. Bank withdrawal limits and exit fees under consideration by financial authorities in Switzerland, according to contentious new report. And from Reuters, in wake of Credit Suisse, Switzerland told to better prepare for bank failure. Now, for those of you that forgot, Credit Suisse was the company that put a 95-cent price target on AMC. They were short AMC. They went tits up, taking on water. Archegos basically blamed for taking them down, another hedge fund, and the government forced UBS to absorb Credit Suisse, to stop the financial contagion. But it doesn't look like it's over if you consider this equity swap. So guys, think about it. AMC is down 90% for the year. Why haven't they covered yet? You can see our chart in the lower left-hand corner. That's the daily. It shows all the damage that the hedge funds and, of course, the reverse split, the conversion, the Adam Aaron tweets about bankruptcy risks and dilution, all of it. You could see the damage that the hedge funds, Adam, Morgan Stanley, and Citi have done to the stock. Okay, but why haven't they covered yet? What, are they waiting for it to go down 95%? And if these hedge fund guys are so smart, why are they still dropping like flies? Like Jim Chanos. How did he go from managing $6 billion down to $200 million and still has to pay back the investors this year? I have a theory. They can't cover even if they wanted to. And I know some of you might not believe me, but I want you to consider this headline from mid-November. Russell 2000 call volumes explode to all-time high. They set a record in short crushing rip fest, realizing they are far too short the Russell to cover cash single names. Okay, that means they're short individual names in the Russell. Okay, the 2000, the small caps. They can't cover and go long. So hedge funds did the next best thing they could. They bought a shitload of IWM calls and then bought even more calls. Now, the chart below reinforces my argument. Single stock short selling. Hedge fund, U.S. single stock short flows increasing for a record 14 consecutive weeks, according to Goldman Sachs. Guys, these people are setting unusual records, wouldn't you say? What I conclude from this, they're so short they can't cover if they wanted to, so they're hedging. But Uncle Frank, you said we're winning the battles and we're about to win the war. How can you say that when our stock price is down 90% for the year? Well, this isn't financial advice, and I'm not a financial advisor. I will never tell you to buy, sell, or hold any security or cryptocurrency. But stock price and market cap is just one aspect of this war. For example, did you know your company is not only the largest exhibitor on the planet, but now also a top 10 distributor thanks to Taylor and Beyonce? That's right. We just pulled ahead of MGM for this year as a distributor. And that's with only 2 releases. Beyonce's film only hit the theaters last night. Furthermore, I contend that if they didn't hold AMC's stock price down, we would have a tidal wave of bankrupt hedge funds, clearing firms, and even some prime banks and brokers. You don't believe me? Then let's review some of the battles. By now, every serious ape has seen the meme on the left. It's always being updated, and it depicts all the hedge funds and banks that have gone down the toilet since this whole thing began. Now, you tell me who's winning the battles. Tiger Global, Tyborn, Mudrick, Anchorage, Melvin, Archegos, Credit Suisse. That's a 167-year-old bank that ain't around anymore. UBS had to come and save it, and now UBS seems like they're in trouble. All right, Kinnikos, which is Jim Chanos. All right, guys, I don't see AMC losing battles. I see hedge funds and banks losing battles. AMC was forced to update and modify its business model after the pandemic, right? So, yeah, we've got a branded credit card. We've got retail popcorn in the world's largest retailer, Walmart. And now we're expanding into 2 other retailers. We have a massive merchandise website and merchandise business. And now, in addition to being the largest exhibitor in the world, now we're a top 10 distributor, at least this year, and we've only just got started. Okay, our total gross for the industry is over $8 billion. Right? That's better than 2020, better than 2021, better than 2022. And we did it on only 514 releases so far. Normally, we get over 900 releases a year. Okay, this is the first time we've been over 500 since the pandemic, and we had to survive a writers and actors strike. That's behind us. Our average capture is almost 16 million a film. That's better than 2019, right? The original bet was, oh, AMC's going bankrupt. Well, it didn't, and we didn't get paid, right? Then they changed the bet. You'll never be profitable again. Well, we were. And now they've changed the bet again. You'll never beat pre-pandemic. You'll never beat 2019. Well, we just had the best third quarter in our 103-year history. Okay, I see AMC winning battles. Yes, we have debt. But does anybody want to talk about the unrealized losses of our enemies that they're carrying on their books? Does anybody want to talk about the sheer amount of securities sold yet not purchased on the balance sheets of our enemies? Everybody only wants to talk about the $5 billion or so that AMC owes. But guys, so far I'm seeing AMC win the battles, and I think they're about to win the war with the next black or white swan. And how are the guys that run AMC's boardroom doing? Morgan Stanley downgraded to hold at Societe Generale, citing growth pressures. Analyst Andrew Lim downgraded Morgan Stanley stock to hold from buy on Tuesday as rising deposit costs paved the way for growth pressures. Lim pointed out that the investment bank had already guided lower net interest income going forward after logging a 9% sequential decline in quarter three. AMC's total revenue grew by 45.2% compared to Q3 of 2022. Right? Net earnings grew by $239 million to $12.3 million compared to a net loss of $226 million in quarter three of the previous year. How many times have I said we're in better shape than our enemies right now, even with our debt load? Would anyone like to discuss Morgan Stanley's unrealized losses on their books or their total securities sold yet not purchased? Now, I'll be the first to admit that the AMC's yearly chart looks bad, but it doesn't look as bad as this one. Unrealized losses at U.S. banks exploded in Q3. Unrealized losses on securities held by U.S. banks exploded by 22% in the third quarter. Of course, unrealized losses don't really matter until they do. This is yet more evidence that the financial crisis that kicked off last March continues to bubble under the surface. Unrealized losses, primarily on U.S. Treasuries and mortgage-backed securities, rose by $126 billion in Q3 and now total $684 billion, according to the FDIC's quarterly bank data release. It's important to understand these are only paper losses. Ostensibly, the banks will hold these bonds until maturity and then will be paid at their face value. If it plays out this way, there won't be any real losses. The problem is that these unrealized losses drastically decrease a bank's liquidity. If it has to sell bonds in order to raise capital, the bank will experience significant losses. This is exactly what took down Silicon Valley Bank last March. I hope you're still with me because there's a lot in this article I feel you should know. Yes, AMC has debt, but our enemies are buried in debt. And if it wasn't for clever accounting, I believe many of them would be considered an ultra high risk. We are not facing potentially billions in synthetic shares that must be accounted for and reconciled. We are not leveraged 40 to 1 or higher. They are. We are not getting pushback from regulators, the Fed, the U.S. Treasury, foreign governments about our leverage levels. They are. Headline: Citadel and its peers are piling into the same trades. Regulators are taking notice. Overcrowded trades by multi-manager hedge funds seen as threat. Regulators warn the firms could destabilize treasury markets. Now stick with me, guys, because I want to show you some things. Even Ken Griffin is a little worried. Multi-manager funds like Griffin Citadel have come to dominate the hedge fund industry, riding a steady run of outperformance to oversee more than $1 trillion, including a healthy dose of leverage. But the explosive growth has led the industry giants to pile into many of the same trades. Now, guys, I believe there's a lot of illegal coordination going on with the trading of AMC and some offshore trading that's questionable, but let me continue. That has built unease among regulators, investors, and traders over these so-called pod shops. And while Citadel's billionaire founder has vocally opposed any notion that his firm and rivals pose systematic risks and need more regulation, even he acknowledges that crowded trades could lead to widespread losses if all of them head for the exits at once. Quote, could you see the multi-manager hedge funds take a joint 10, 15, 20% hit to their equity? It's possible, Griffin said during a November 9 interview at a Bloomberg conference in Singapore, calling such a drop painful but not systemic. Citadel, short AMC. Millennium Management, short AMC. And Balyasny Asset Management, once short AMC, are the leaders in a strategy that divvies up money across dozens or even hundreds of teams that operate somewhat independently across a range of markets and strategies. That's the pods, completely unregulated, it would seem. Their success in the past several years has drawn new investors and competitors, yet overcrowding in some bets, increased market volatility, an expensive talent war, and lower returns this year have prompted market participants to question whether the world of high finance is approaching peak pod. Officials at the SEC and U.S. Treasury Department have warned that the firm's favored basis trade could destabilize treasury markets. At least one large bank is approaching the limit of how much it's willing to lend to them, and some investors are growing more wary. Quote, there's some overcrowding and concern about the amount of leverage at individual firms and collectively. John Jackson, head of hedge fund research at investment consultant Mercer, said during a recent Capital Allocators podcast, and because they typically cut risk very quickly, we are worried about the potential snowball effect. Some investors are capping the amount of money they allocate to these funds, fearing blowups. Others are avoiding newer entrants, saying they could be hurt the most by a big unwinding. Smaller hedge funds, meanwhile, are looking for ways to profit from the market dislocations these larger competitors create. Then we've got a chart titled Assets at Multi-Manager Pod Shops have swelled, right? So they show the top 8. Among them, Citadel, Millennium, Balyasny, Exodus Point, Verition Fund, Hudson Bay, all short sellers, either were or are short sellers of AMC. So that's 6 out of the top 8. Stop thinking this isn't about you, because it is. Now, what didn't the 4 authors of this article mention? How about that Citadel has been caught 60 times breaking securities rules and laws? How about that they were banned in China for 5 years and fined $97 million for illegal short selling? How about the failure to mention it may be illegal or at least an unfair advantage to be a hedge fund, a securities firm, a market maker, and operate an ATS, more commonly known as a dark pool? Now, what do they talk about? Volatility. Here's another chart. Citadel's annualized volatility spiked in 2021. No kidding. What happened in 2021, guys? Much of the increased regulatory focus has been in treasury markets. We're not going to investigate what they did in meme stocks or are still doing, where leverage trends tend to be the highest. Hedge funds in aggregate had an estimated leverage of 56 to 1 on $553 billion of treasury repo borrowing as of December 2022. And that was according to, a September research note by Fed Reserve staffers, right? That's why many of the big firms incurred larger than expected losses during the early days of the COVID-19 pandemic. They were caught in the so-called basis trade, which is designed to profit from small differences between Treasury futures and the cash market. Considered a safe arbitrage bet, if held to maturity, it can occasionally go haywire, as it did in March of 2020. The Fed was forced to step in and calm markets, pledging $5 trillion of stimulus. You know what else these authors didn't mention? That Robinhood was forced to take away the buy button. Coordinating with the SEC and the DTCC, if they didn't take away the buy button, Citadel would have went down, the clearing firm Apex would have went down, Robinhood may have went down, maybe you would have dragged a prime bank or prime broker with you, but we're not going to talk about that. We're just going to talk about the basis trade. The article continues, a succession of mini quakes, including March of 2020, prompted the Bank of England to include Citadel, Millennium, LMR Partners, and Steve Cohen's Point 72 Asset Management, as well as other hedge funds in its stress tests. So prior to that, the Bank of England was, doing stress tests of banks, but the risks were so huge, they started including the hedge funds. LMR, an $11 billion pod shop with no down years until then, was among the biggest casualties that month. It had made highly leveraged trades, wagering around volatility arbitrage, dividend arbitrage, and the basis trade. As bets across the industry imploded, its main LMR multi-strategy hedge fund plunged by a record 24%, mostly hit by volume arb, according to investor letters seen by Bloomberg. Meanwhile, the LMR Alpha Rates Trading Fund, which counts the basis trade as a key strategy, lost 4%, also its worst month ever, the letters show. In response, the firm exited strategies, including relative value trading in credit, equity index, and cross-asset. It shut down the LMR Long Horizon Fund after its bets on volatility backfired. The firm also bolstered its risk management team, appointed product heads, and embarked on a more rigorous monitoring of its portfolio managers. The multi-strategy fund ended the year down 6%, its only annual loss since its debut. The rates fund fully recovered. Losses rippled through almost every big multi-strat shop, and at least one trader likened the panic to the 2008 financial crisis. Who is LMR? That's a British multi-strategy investment firm. Are they short AMC? Sure are. As of November 14, 13F, they got 175,000 puts. And just look at that list. Citadel, Millennium, LMR, Point 72. Steve Cohen, you remember him from Dumb Money? Yes, these were or are shorters of AMC Entertainment. Okay, guys, this is the next narrative the financial press will be throwing at us. From Variety, Christmas at the box office hinges on Aquaman 2. Movie theater owners are worried. From the article, every year around Christmas, Phoenix Theaters puts all of its chips on one major tentpole, gambling on a movie so big, so broadly appealing, it'll keep auditoriums stocked into the new year. In the recent past, the Midwest-based chain has gone all in on 2022's Avatar, 2021 Spider-Man, and 2019 Star Wars: The Rise of Skywalker. But this holiday season is different. For the first time in more than a decade, excluding the pandemic-stricken year of 2020, that's when theaters were closed, when Hollywood was starving theaters for releases, when Adam Aaron doubled his comp plan. There's no surefire blockbuster with the potential to gross $1 billion globally to cap off the year. Quote, you can't look at the release schedule between now and the end of the year and find one movie that stands out, like Avatar, as the big film, says Phoenix Theater owner Corey Jacobson. Okay, that's true. We don't have an Avatar for Q4 of 2023. But the one thing we have that Phoenix Theaters, don't have is Taylor Swift and Beyonce. So I still am pulling for Q4 to be huge. Now here is some good news for Q4 from The Hollywood Reporter. Godzilla -1 is a giant hit with critics. See it on the biggest screen possible. The 37th film in Japan's long-running giant monster movie franchise marched into U.S. theaters on Friday, and the early reaction from critics is ecstatic. Godzilla Minus One isn't just a good Godzilla movie, writes Real Views critic James Berardinelli in a characteristic take, quote, "It's an excellent Godzilla movie, arguably the best ever to grace the screen." So maybe you could see that this weekend. And so far, guys, Beyonce's looking good with this headline from Deadline. Early December box office feeling halo from Renaissance, a film by Beyonce with $20 to $25 million opening, 99% positive audience exits. The weekend ticket sales for AMC's second concert aren't tumbling down, and they're making a sound. After a solid preview night, in line with what we saw for first day pre-sales of 6 million plus, the concert docu-movie directed, written, produced, and starring the 32-time Grammy winner is eyeing a $20 to $25 million opening at this point. So looking good so far. To be perfectly honest, December may surprise everyone, even though we don't have an Avatar to drop. We are kicking it off with Beyonce, and yes, we have Aquaman, but we'll also see Willy Wonka. We'll see Ferrari, the store of Enzo Ferrari, dropping on Christmas, so it may not be a total loss of a month. Hey, what can I say, guys? I gave it my best shot. My time window for last week was really disappointing. I also thought Thursday was going to be the hot day, but it turned out to be Wednesday, where we got as high as $7.34 a share, and a lot of people are giving the closing of that meme ETF credit for that day's rally. On Friday, AMC closed at $6.86, up 21 cents or 3.16%. We got as low as $6.53, and I'm posting my best fill for the day, which was $6.57. So I'm still in the trenches buying with you guys, and I still believe 65 cents per share on a pre-split basis represents an amazing opportunity for this company. This is not financial advice, and I'm not a financial advisor. I'm just sharing some of my trades. Based on that last price of $6.86, expect support to the downside Monday at $6.60, $6.33, and as low as $6.14. Expect resistance to the upside at points $7.06, $7.25, and $7.52. On the Ripple XRP front, I see the following catalysts coming ahead. Number one, a final resolution to its legal battle with the SEC and Gary Gensler. Number two, that would pave the way for an XRP exchange-traded fund, or ETF. And yes, as the fifth largest and one of the most popular coins in the world, I think it will eventually get one. I also think Gary Gensler is the main reason we aren't getting one now. And yes, I think Gary is directly responsible for keeping BlackRock from even planning and releasing one. And three, there's the IPO of Ripple itself. Let's take a look at the headlines. XRP News, SEC faces sanctions amid legal battles with Ripple. The U.S. courts continue to find fault with the SEC and its quest against the crypto space. Yet U.S. lawmakers appear unfazed by the negative media. And another SEC meeting spurs Ripple settlement rumors, but XRP CLO thinks company can win in court. And then finally, will SEC settle with Ripple today as regulator holds closed-door meeting? Now, I want to talk briefly about this settlement. Have you noticed that only the one aspect that the SEC won in its case against Ripple XRP was the private placement of tokens with institutions? And what does the SEC want? They want $750 million. Now, when Ken Griffin marks millions of short orders as longs, they ask for $7 million. But with XRP, they want $750 million. Are you starting to see the bias, guys? Okay, I believe that once the SEC is completely out of the way, XRP is going to have a path higher. Not investment advice or advisor. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.